Hello and welcome. If you're gearing up for the NISM Series 12 exam, you already know Chapter 6 on derivatives can seem a bit tricky. So in this explainer, we're going to break it all down, step by step, to make sure you've got these core concepts down cold. Let's start with the very basics. So here's our game plan. First, we'll tackle the big question, what even are derivatives? Then we'll get into the four main products you need to know. After that, we'll look at the nitty-gritty of how they're traded and settled, and the super important risk management systems that keep everything running smoothly. And to finish up, we'll go through a quick recap checklist to get you ready for the exam. All right, let's jump right in. The best place to start is with the most fundamental question of all. Why do derivatives even exist? Well, they were created to solve a huge problem that pretty much everyone faces, from farmers to giant corporations. And this right here is the problem. Just imagine you need to buy or sell something, say, 3 months from now. The problem is you have no clue what the price will be then. Is it going to shoot up? Is it going to crash? That uncertainty, that's risk. And derivatives, really, at their heart, are just tools designed to manage that exact problem. Okay, so here is the official textbook definition. And the most important word on this slide is derived. A derivative contract has zero value on its own. It's not like a share of a company. Its value comes entirely from the price of something else, and we call that something else the underlying asset. This could be a stock like Reliance, an index like the Nifty 50, a commodity like gold, or even a currency like the US dollar. Let's make this real. This slide shows you the two sides of the exact same coin. You've got a gold buyer and a gold seller, and they face completely opposite risks. The buyer is worried prices will go up, right? The seller is worried they'll go down. So a derivative contract lets them come together and lock in a price today for a deal that will happen in the future. It gives both of them the certainty they need to run their business. And that leads to a really crucial point you need to understand. Derivatives don't create new money or new wealth. They simply transfer risk from one person to another. And because they're transferring risk, they're also transferring wealth. In our gold example, if the price of gold goes up, the buyer who locked in that lower price wins, and the seller who agreed to that price loses out on some potential profit. For every winner, there's a loser. The net result is always zero. It's what we call a classic zero-sum game. Okay, so now we get why derivatives exist. Let's look at the actual tools of the trade. There are four main types, and for your exam, you really need to know what makes each one different. We'll start with the oldest and probably the simplest form of them all. Forwards are the original derivative. The best way to think about them is like a private handshake agreement. It's just between two people, over the counter, not on an exchange. A farmer and a miller agreeing on a price for wheat in 6 months, that's a perfect example. Everything is customized, the quantity, the quality, the exact date. But that flexibility is also its biggest problem. Because it's a private deal, there's a huge risk that one side might just back out or go bankrupt. We call this counterparty risk. So how do you solve the problems with forwards? Well, that's where futures come in. You can see the evolution right here. Futures are basically forwards that have been standardized and moved onto a regulated stock exchange. So instead of a private, custom deal, a futures contract has standard terms for everyone. And, this is the most important part, the exchange's clearing corporation steps into the middle of every trade. It guarantees the deal, which completely gets rid of that counterparty risk. Now, for our third product, options, things get really interesting. This is a total game changer. You see, forwards and futures create an obligation. You have to follow through. But an option gives the buyer a right. A right, but not an obligation. If you buy an option, you get the choice to do something, but you don't have to. This is the single most important thing to understand about options. You have a choice. And options come in two main flavors. A call option gives you the right to buy the underlying asset at a certain price. You'd buy a call if you're bullish. You think the price is going to go up. Think of it as calling the asset over to you. On the other hand, a put option gives you the right to sell. You'd buy a put if you're bearish. If you think the price is going down, you're putting the asset onto someone else. Okay, two more terms you absolutely have to know for options. The strike price is that pre-agreed price, the price at which you have the right to buy or sell. The option premium is the fee you pay up front to get that right. The best way to think of the premium is like an insurance payment or a non-refundable deposit. It's the cost of having the choice, and it's also the absolute maximum amount of money the option buyer can ever lose. And finally, we have swaps. Just like the name says, this is a contract where two parties agree to swap cash flows. The most common kind is an interest rate swap. Imagine a company has a loan with a floating interest rate, which is risky. They can enter into a swap with the bank to swap that risky floating payment for a predictable fixed payment. They've effectively traded away their uncertainty. So we know what these products are, but now let's pull back the curtain and look at the market mechanics. How does this all actually work on an exchange? Understanding the trading and settlement process is absolutely key to understanding the whole market. Remember how we said futures are standardized? Well, this slide shows you exactly what that means. The exchange sets all the rules. The expiry date, which for stock derivatives in India is the last Thursday of the month, the available contracts you can trade, the lot size, which is the standard number of shares in one contract, and even the tick size, which is the smallest amount the price can move. It's all predefined, so everyone is playing by the same rules. Now, this concept is absolutely critical. Mark-to-market, or MTM. Think of it as settling up your account at the end of every single trading day. The exchange looks at your open futures position, compares it to the official closing price, and calculates your profit or loss for that day. If you made money, that cash is in your account the next day. If you lost money, it's taken out. This daily settlement is a massive risk management tool that prevents huge losses from building up over time. So what happens when the contract finally expires? Well, it depends. For index derivatives like Nifty futures, the final profit or loss is just settled in cash. But, and this is a huge point for your exam, since October 2019, all futures and options on individual stocks are settled by physical delivery. That means if you hold the contract until the very end, you have to actually buy or sell the real shares. We've mentioned risk quite a bit, right? From counterparty risk to the daily MTM, the whole exchange-traded derivatives market is built on a really powerful system of risk management. So let's look at the safety nets the exchange uses to make sure the market stays stable and secure. The clearing corporation basically has a multi-layered defense system to protect the market. It starts by making sure its members have enough capital. Then, for every single trade, it collects something called margin. It also puts limits on how big of a position anyone can have, and it watches everything in real time. If someone breaks a rule or a limit, their system can be shut down automatically. It's a very robust safety net. Of all those tools, you really have to understand margin. Now, margin is not a down payment. Think of it more like a security deposit or collateral. It's money collected up front to cover any potential future losses. There are two main parts. You have the initial margin, which is calculated based on the estimated worst-case one-day loss, and then you have the exposure margin, which is an extra buffer added on top of that just to be safe. Okay, we've gone through a lot of information, so let's bring it all together with the final checklist. These are 3 concepts that are very likely to show up on your NISM exam, so make sure you can answer them clearly. Let's run through them. What's the role of the clearing corporation? It steps into the middle of every trade. It becomes the buyer to every seller and the seller to every buyer. By doing this, it guarantees that every trade will be settled, which completely eliminates counterparty risk. Second, how is that daily MTM price calculated? It's not just the last price of the day. It's the weighted average price of all trades that happen in the final 30 minutes of trading. And third, what's the difference between an American and a European option? In India, we trade European options, which can only be exercised on the final expiry day. An American option gives the owner much more flexibility. They can exercise it at any time they want, right up to the expiry. And that wraps up our deep dive into derivatives. We've covered the what, the why, and the how. So the final question I'll leave you with is this. Now that you understand these powerful tools for managing risk, how could you actually use them to protect or even enhance a real investment portfolio? Keep that question in mind as you continue your studies. Thanks for watching and good luck with the exam.